Welcome to our platform for investor education. In this module, we will be continuing to look at the framework for evaluating investment opportunities. Earlier, we had looked at cash, fixed income, and bonds as different investment opportunities that investors could engage in. Now, we will start looking at how these rewards from those investment opportunities matter when it comes to evaluating them in terms of risk. The pyramid here lists stocks and then real estate. Depending on the geographical region we are in, one could argue which should be on the left and which on the right. In terms of income, after all, stocks give you dividends while real estate gives you rent. The relationship between home prices and rents versus stock prices and dividends can be quite different from region to region, which is why the placement on the pyramid is even an issue. For instance, between the US and India, the differences are fairly stark. Rental yields are 5% in the US and 1.5% in India. Dividend yields are 3% in the US and 1.6% in India. These numbers relate to residential rental income, not commercial rental income. For example, a 3 crore flat in Jayanagar, Bangalore can fetch a rent of about rupees 4.2 lakhs per year, which is where my 1.4% comes from. Correspondingly, a $1 million home in California fetches about $50,000 per year in rent, or about 5% in rental yield. Correspondingly, US stocks on average pay dividends that are about 3% of price every year. Indian stocks yield about 1.6%. In India, stocks pay much lower dividends than in the US. This is largely because ours is a much younger equity market, about 2.5 trillion in market cap, while the US, at about 20 plus trillion, is a much older one. The appreciation growth in their value over a period is the real attraction. Likewise, while real estate prices in urban India have been in somewhat of a slump since demonetization, many people have made far more money from real estate investment than from equities. Another common argument used is that the supply of land is fixed, while companies and their stocks do come and go every day. For most middle-class investors indeed, their home is their largest financial asset, equities a distant second. As with gold, there are subgroups within the real estate and stock categories as well, each with different risks. Utilities provide electricity, telephone, and other essential services. They have stable revenue streams, don't show much capital appreciation. Growth stocks, such as the Amazons and the Facebooks of the world, have in contrast shown stellar appreciation in their stock prices. But what are the risks in these growth and appreciation groups? Companies fail for many reasons: mismanagement, poor products, unethical, even illegal behavior. This can cause their stock prices to collapse. Real estate builders are also notorious for not meeting promised deadlines and for taking on too much debt. In India, people selling you financial investment products are very often quick to tell you how soon you can double your money, but not as quick to tell you how much risk that doubling might involve. I do not believe this to be the correct approach, nor one likely to keep invested in equities for very long. I think the better approach is to accept that there is risk and put the management of that risk first and foremost. There are many methods and formulae to define and measure risks, and they do appear in other content on this platform for investor education. For now, I want to make two simple observations. One is that if you're having trouble sleeping at night worrying about your investments, you have too much risk exposure. The second, that we in India are very far from the equity culture that is evident in the West. There are, after all, an endless number of scams reported in the media almost daily. There is much to be done in this country by regulators, by financial institutions, and by government. Our concern, understandably, is more about return of capital rather than return on capital. But as you have seen, even when you want the safety of that capital from fixed deposits, you still have purchasing power risk. Now let's look at this framework for evaluating investment opportunities on the pyramid from a life cycle perspective. People who are older and closer to retirement might actually find themselves and should find themselves at the bottom of the pyramid. After all, safety of principal and generation of income are their primary goals. Younger investors who are at a different point in their life cycle might actually be willing to take on a lot more risk than the older investors themselves. For these investors, it's not just about safety of capital, but it's also about capital appreciation and investment growth. For them, they should consider equity as a viable investment alternative, whether that equity comes in the form of investing directly in stocks or in the form of putting their money into equity mutual funds. Mid-career investors should find a mix of equity and fixed income that is consistent with their risk tolerance. Whichever category of investor you happen to be, I'm confident that in our platform for investor education, you will find content that is most appropriate to your needs. As we conclude this video, I want to say, keep watching our videos, keep looking at our platform for content and increasing your knowledge towards wealth creation. Thank you.